Goedemiddag, welkom bij een nieuwe KoersKompas podcast. Vandaag heb ik Michael Howell te gast. Hij is de koning van de liquiditeit, zoals dat heet. Michael heeft heel wat ervaring op de beurs, heel wat ervaring in de economie. En hij gaat ons vandaag proberen wat bij te brengen over wat de bedoeling is met liquiditeit, wat dat betekent en hoe dat zich manifesteert in de markten. Michael, thank you for coming on.
Great pleasure, Bart. Good to be here.
Awesome, thank you. Maybe first, let's start maybe with a brief introduction.
Okay, let me try and describe what we do. I'm Mike Howell. I run a company called CrossBorder Capital from London. CrossBorder Capital is an investment advisor. We've been in the business for actually 30 years now. My background was that I was in investment banking. I worked for Salomon Brothers, the US investment bank, the sort of doyen of the bond markets, beginning in the late 1980s through to the mid 1990s. And basically what we do is track liquidity flows. The key thing that certainly I understood when I was at Salomon Brothers was that money drives markets. And it's really just a question of understanding where the money is and the direction it's traveling to give a lot of insight into how asset markets and economies ultimately move. And that's pretty much what we do. We've been tracking global liquidity for a long time now, several decades. We have an integrated system. We basically cover 90 central banks and financial systems worldwide. We gather we gather data on a monthly and sometimes a weekly basis, which gives us a lot of insight into how markets are moving.
Right. So what is the composition of liquidity? What entities are pushing and pulling it, so to speak?
Okay, well, let me sort of describe two things. I mean, one is that I think we need to first of all define what liquidity is, and then we can sort of from that point really understand who are the main drivers, as you say. Liquidity in our terms is the flow of money or funds through global financial markets. It's not the common aggregates that people quote like M1 or M2. That's much more money in the real economy, or if you like, retail bank deposits. This is the sort of thing that you would see flowing through a high street bank, for example. That's not what's driving financial markets. What's driving financial markets is what you might generally call wholesale money, not retail money. And it's that wholesale money that we're really focusing on. And that wholesale money is, we gather it by looking at data from central banks, what central banks are doing in money markets and in fixed income markets. We look at it in terms of what banks are doing outside of their retail activities. We look at what are called shadow banks, which are basically hybrid financial institutions that operate on the fringes of the financial system. And we look at cross-border flows. So all these different factors are very important. Now, many people ask me, well, okay, if we want to kind of quick and dirty view as to what's happening with global liquidity, what should we really be looking at? And I say that it really comes down to probably three main things. One is what the Federal Reserve is doing. I mean, that I think most people would accept that the Federal Reserve is critical, particularly being the overseer of the dollar financial system or the world financial system. The Federal Reserve is clearly key here. The second thing is the People's Bank of China. Now, too few people look at the People's Bank, but since the People's Bank is a very large central bank and it basically controls to a much greater extent, in fact, than the Federal Reserve equivalent does, the Chinese economy and the tempo of the Chinese economy. And the Chinese economy is clearly the elephant in the room when it comes to manufacturing capacity worldwide. We need to understand what the People's Bank is doing. So that's critical. And then the third thing that's important is a more wonkish concept, which is basically looking at something called the MOVE Index. Now, the MOVE Index is a little bit like the VIX index, but the MOVE Index is a measure of volatility, not applied to equities, but applied to fixed income markets. And it actually measures volatility across the US term structure. Now, why is that so important? And the reason it's so important is that since the 2008-2009 global financial crisis, most lending or credit flows through global financial markets are now collateral based. They're not the result of trust between banking groups. Basically, the repo market, which many of your listeners will likely understand, the repo market is a form of lending market, but it's backed by collateral. So in other words, let's say, own a US Treasury bond, and I go to a credit provider and I say to the credit provider, look, here is a treasury bond as collateral. Will you lend me money against that treasury bond? And that treasury bond will then get a haircut by the credit provider. That haircut might be 95 cents in the dollar, for example. And so for every $1,000 that you post, you can basically borrow $950 of credit against that collateral. Now that haircut is it varies. Sometimes it's basically 5 basis points. Sometimes it's a bit more. Sometimes it may be 10. So the point being is that variation is all based on the volatility of the markets. So if you have lots of volatility in the collateral markets or in the bond markets, what happens is that credit providers give a bigger haircut to the collateral, and that means you can borrow less, and they will lend you less. So basically, the pool of liquidity commensurately shrinks with that change in what's called the collateral multiplier. So number one is central banks. Number two is the collateral system and understanding repo. And that's what we really try and do.
Right. Sounds good. What is your liquidity framework telling you right now about the current situation here? I assume it can be looking all that rosy, or what are you seeing?
Well, I think there are three things to say really. One is about the general structure of the financial system, and I can go into detail by looking at that structure in a moment. The second thing is to understand the role that the financial system plays in terms of debt refinancing. And the third point, which is a shorter term one, is what is the data actually saying right now? Now, let me work backwards and say, what is the data saying right now? Basically, liquidity is flatlining. And there's no particular impetus upwards or downwards. We've been in a range really for the last few months. And the upward impetus of liquidity that we saw beginning in September, October of 2022, which launched a bull market in financial assets, is now kind of coming to an end. And we're really at a juncture, which may mean that liquidity goes up from here again with another step up, or it goes down. And if it goes down, clearly that's not good. The second question is, what is that liquidity? Why is that liquidity so important? The reason it's so important is that we live in a debt-dominated world. And in a debt-dominated world, what's really important is the ability to refinance or roll over your debts. And if you think of the example of a home mortgage, if someone is living in a house that's mortgaged and you have a 20-year mortgage and that mortgage comes up for renewal, it's not so important what the interest rate that you're asked to pay on that mortgage is. I mean, clearly it matters, but what really matters is whether you can get the roll from another lender, whether someone will extend that mortgage. If you don't get that mortgage extended, you're homeless. They will take repossession of the house. And the same thing generally with the debt markets. What you need is the debt needs to be rolled over because, spoiler alert, debt's never repaid. It just keeps rolling on and rolling over. If you get interruptions in that rollover, you get financial crises. Every financial crisis in the last 30 or 40 years, in our view, has been a debt refinancing crisis. It's arisen because of an inability to roll over debt, and that's because there's a lack of liquidity. Now, why is liquidity so important? Because liquidity essentially measures the balance sheet capacity of the financial system. And what it means is that if you haven't got the appropriate capacity, you can't roll over debt, and therein you get a problem. And that's really what we want to understand. Now, what I can show you is a few slides which perhaps drill into that, and hopefully from that we can get a better understanding. So let me try and switch to some slides, and if you can see that presentation, I'm gonna
Yes, I can. Yes.
progressively go through that. So this, by the way, is a pointer. I'm just going to leave this one visible for a moment, which is basically looking at the MSCI World Index, which is shown in orange, and the dotted line is an average equity bull market from 1970 onwards, just index based to where we are now. And we've overlaid it on the current MSCI World Index. And the 0 point in the middle of the chart is the floor of the bear market when you get essentially the low in the market, and then what you see is a bull market rally. And what we're seeing right now is that world equities are rolling over, absolutely on track with a normal cycle. But let me come back to that and go to the point about the global financial system, and that's here. Now, this diagram looks kind of maybe complicated, but I've tried to simplify it as much as I can to try and understand or educate people as to what's happening within the global financial system. The bottom line is that this system is not particularly robust. It is extremely dependent on the central banks, which you can see on the bottom left and on the bottom right, acting either as lender of the last resort on the left or dealer of the last resort in the collateral markets on the right-hand side. In the center of the diagram, there is a box called collateral, and between collateral and the circle at the bottom, global liquidity, there is a yellow oval, which is labeled repo market. The repo market is, if you like, the interface between global liquidity and collateral. And the repo market often is the choke point of the global monetary system, increasingly so in the last 20 years. So we need to understand what's happening in the repo market. Now, the repo market, as I said, brings together liquidity and collateral. So effectively, if you post collateral, you're repoing that. In other words, a sale and repurchase, which will give you an ability to borrow against that collateral. Collateral really takes two forms. One is public debt instruments, for example, bonds in the Eurozone or US Treasury securities more generally. And those are what are often called pristine collateral, which almost any credit provider will lend against. Okay. And that's really how the traditional monetary system worked, even when it was in a much simpler form with traditional banks. And then on the right-hand side, in that orange circle, there is something which is labeled shadow banks. And in that circle, it says private debt instruments, including CLOs, which are collateralized loan obligations. Now, those are private sector-based collateral instruments, and they are very market sensitive. And the point about the global financial system is it is leaning more towards the right than the left. So because of what you would say is increasing regulation on the banking groups, more and more financial activity is moving into the shadows where it gets out of the regulatory net, and effectively credit providers can act more freely. And that regulatory arbitrage is pushing more and more emphasis onto private credit instruments. Now, what that means is it makes the system a lot more fragile. As we say, it becomes deviation amplifying, it becomes very pro-cyclical and effectively potentially volatile. And it puts a great deal of strain on the central banks to try and manage the system through intervening in the collateral markets. And in many cases, the global financial system today is all about collateral, whereas 25 years ago, it was all about high street banks. So the system has changed, it's morphed or reformed. And it's that understanding that repo market and collateral centerpiece, which is really important. Now, why am I going on about this? And the reason is, if you look at this chart, and this is what's happening right now in the US markets. Now, this is a measure of the strain or the tensions that are in the repo markets in America. And this is looking at a repo rate, which is called SOFR, which is the system overnight funding rate, minus Fed funds. And Fed funds clearly is what the US Federal Reserve targets. This spread, which you can see illustrated in orange, normally ranges between those two tram lines that I've indicated. So in other words, the Federal Reserve is trying to get market rates, i.e. SOFR rates, controlled. What you're starting to see more and more evidence of, particularly if you can squint at the chart and see the dates there, 2024 starts about 2/3 of the way along that graph, but you can see that there are increasing upper displacements in that chart. The orange line is jumping up the page, and that's saying there are increasing tensions in the repo markets. And that's something that the Federal Reserve has got to address. And that fundamentally is that liquidity is running out. Now, why is that an important issue? And I'm going to go back to this chart which I passed over earlier on. Why is this so important to understand? And this is important to understand for all investors of all stripes, whether you're investing in gold, whether you're investing in Bitcoin, whether you're investing in US equities, Eurozone equities, whatever. This is basically looking at the general tensions in the global financial system and really what matters. And this is looking at the ratio between all debt in the world economy, or in fact, to be strictly accurate, in the advanced economies, as a ratio between that debt and the domestic stock of liquidity that's available. So think of this as being world debt divided by global liquidity, very crudely. Now, that ratio is a lot more meaningful than the conventional tool that economists talk about, which is debt to GDP. I fail to understand why debt to GDP is important. I don't think it is. I don't think it means very much. Debt to liquidity is critically important. And the reason that debt to liquidity is so important is that you need to roll the debt over. And you need balance sheet capacity within the financial system to do that. And balance sheet capacity is measured by global liquidity. So if you don't have the capacity to roll the debt over, you get a financial crisis. The chart shows a dotted line that's drawn through roughly the middle of the page. That is a statistically estimated mean reversion level or equilibrium level for that ratio. And what it shows is that if you're above that line, you find that you get, particularly if you're well above the line, you get financial crises, which I've labeled. Okay, so all those financial crises occur when the debt liquidity ratio is stretched. What you find is that when you're below the dotted line, you tend to find that you get asset market booms. And asset market booms are when liquidity is abundant relative to the needs of debt refinancing. And you can see the various examples of that. But what we've just come through is a very significant excess liquidity period, which I've labeled the cryptocurrency boom, because that's been a large event for excess liquidity. Now, why did that ratio fall so dramatically from the period of 2010 onwards? And why is it slated to rise in the next 2 years? And those are critically important questions to understand. The answer to the first question as to why did it fall so much, there were, broadly speaking, two reasons. One is that central banks moved with alacrity after the GFC in 2008-9 to pump liquidity back into their financial systems to stop many traditional banking groups, particularly Lehman, particularly the US insurance giants, the US Fannie Mae, Freddie Mac, and also Eurozone banks from stumbling badly in the wake of the GFC. So they pumped in liquidity. Secondly, at the time of the COVID emergency, central banks again moved with alacrity, even more alacrity, in fact, to pump even more liquidity back into markets because they thought it was the end of the world with COVID and they needed to restore economic activity. So there was an abundance of liquidity created. The second thing that occurred was that interest rates were slashed to near zero levels. So what that meant was that if you're a corporation or a government, it made a lot of sense to term out your debt. In other words, to refinance as much as you could at zero interest rates, and the term of that debt would, broadly speaking, be 5 to 7 years. So if you add to 2020 5 to 7 years, you get the idea that an awful lot of debt is coming due in the next 2 to 3 years. And it's that debt that was termed out that is coming due is what analysts have been referring to when they talk about the debt maturity wall. And that debt maturity wall is a challenge to financial markets because it means there's an awful lot of refinancing to do. Now, the reason that line goes up sharply is that is a reflection of this debt refinancing that's needed. And we assume that liquidity moves in a pedestrian way. In other words, there's no evidence that central banks are increasing their liquidity injections. They're keeping it a gentle trend. And that's really the worry that we've got. So what you've got here is a situation where, number one, financial markets are really seeing their normal cyclical moves, we've got to look for reasons why there may be downside risks in markets. And secondly, we're sitting on top of a global financial system that not only is structurally fragile and very dependent on the central banks, but the central banks aren't doing very much at the moment. And we've got a big problem down the road, which is debt refinancing. And that's, in a nutshell, what the issues are.
Right. I think you probably have some opinions about an inevitable restart of QE here.
Yeah, I mean, it has to happen. And the
Yeah.
reason it has to happen is if you think logically about this process, and if you accept my view that we've got to have a stable debt to liquidity ratio, if debt is expanding, which it is in every economy, every major economy worldwide, and it's expanding at a rate of about 8% per annum, at least, okay, that's the sort of projections. Clearly in Germany and probably in the Eurozone, you've got to expect with the debt brake taken off, that debt starts to grow even faster than that. Now, if debt is growing at that pace, in order to be refinanced, liquidity has to grow at that pace. And therefore, what you're getting is what we term a monetary inflation. Now, in a monetary inflation, you need monetary inflation hedges. And the two most obvious monetary inflation hedges, one is taken from history and one is taken from recent performance. First is gold. Gold always responds to monetary inflation. Gold may not be a high street inflation hedge necessarily, but it's a brilliant monetary inflation hedge. In other words, it protects against the devaluation of paper money. And the other is Bitcoin, because Bitcoin has done splendidly well in the last 10 years as a monetary inflation hedge. So in the long term, one's got to look at these instruments. Now, to evidence that, think about what's happened since year 2000. In year 2000, or between now and year 2000, the US debt stock has increased 9.6 times. So almost tenfold government debt has increased in America in the last 25 years. An astonishingly large amount of debt increase. How much has the gold price gone up over that period? The answer is 9.65 times. So gold has absolutely matched and a tad more the increase in US debt, which is exactly what you'd expect. So if people are saying, well, debt is not going to increase anymore, we believe the Doge in America, we believe that US finances are going to be in order. We think that Europe is faking this increase in government spending and debt, and it's all going to end happily, and there's going to be no more debt. I'll come quietly and say, you don't need to own gold because there's no need. Or you don't need to own Bitcoin, no need. But that's not the reality. The reality is that governments are kicking the can down the road. This is the course of least resistance. They're taking on more and more and more debt. We're all overtaxed as nations. Everyone demands more government spending, mostly because of mandatory outlays on Social Security and Medicare and these sorts of things. And the only route the governments have, therefore, is either wealth taxes, which are clearly a very unattractive option, but it's coming, or more debt increases, and that's really inevitable. So in that situation, what you've got to do is start to move more and more towards these monetary inflation hedges.
Do you have any time frames in mind, or are you willing to speculate on any maybe time frames on if we're going to see a downturn here in the economy and the markets and everything, when that might bottom out and we'll see brighter days, sunshine?
Well, I think that the first thing to say, Bart, is that the trend is there, and the trend is your friend in the long term, and therefore you've got to change portfolio structure away from holding excessive amounts of fixed income on a long-term view, and you've got to start thinking about what assets you're gonna own that will protect you against monetary inflation. Now, if my figure of 8% per annum is correct, what you've got to say is that is the minimum that I want from an investment. Okay, that's what I should be aiming at. Gold should give you that because gold is a monetary inflation hedge. But what's more, what you're also getting from gold is the fact that many other central banks, aside from Western central banks, are actually accumulating gold as if it's going out of fashion. Evidence what's happening with the Chinese. They're buying gold whenever Western central banks are foolish enough to sell gold, the Chinese are their first bidder to buy it. And this is happening across many Asian and emerging economies. They're buying up the gold. So what you'd expect is gold will outperform. Bitcoin, which is extremely sensitive to global liquidity, should also outperform. Equities should probably match the increase in monetary inflation. But then the question is, what about interest rates or government bonds? And unless interest rates go up to levels like 8% or plus, you're not going to get the same return out of fixed income. And that's the problem. And governments will make sure that interest rates don't go up that much because they're paying the interest bill after all. So they're going to want to keep it as depressed as they can. So this is the reason you don't want bonds. That's the long-term picture. In the short term, we've got to start to judge what's going on in markets. And what I would say is there are two things that one needs to really understand here. One is the dynamics of the last 12 to 18 months. What has been driving the US bull market and more generally the world economy? And secondly, how is that how is that unfolding right now? Is it deteriorating? Are we getting a serious deterioration? So let me try and address those two questions, and I'm going to again show you a couple of charts. The first one is this one, which is at first sight maybe not straightforward, but I think there's a lot of insight into what goes on here. This is basically a hidden easing by the US authorities. And what I've labeled this is not QE and not yield curve control. The not QE is basically what the Federal Reserve is doing, and the not yield curve control is what the US Treasury is doing. The not QE element, which is shown as the orange area in the chart, basically peaked at about $2 trillion in early 2024. And what that was all about was effectively looking at the extra avenues that the Federal Reserve could use, or channels, to inject liquidity into the markets outside of their headline QT policy. So they were supposedly doing QT, quantitative tightening, but actually they were in reality adding liquidity, because there was a channel or different channels they were using. And without getting caught in the weeds here, things like movements in the Treasury General account on the Fed balance sheet, things like the Bank Term Funding Program, things like the Fed's operating losses, which were a gain for the private sector, or things like the rundown of the reverse repo facility, all added liquidity. And the peak, that was 2 trillion, and it's currently virtually nothing. The bigger element was the red area, and that was effectively the change in the funding dynamics of the US Treasury. Janet Yellen very cleverly switched issuance from longer dated coupon bonds and notes, for example, 10-year tenors, towards bill finance. So in the last 24, 28 months, something like 60% of the US deficit has been funded by bills, that is short-term government instruments up to a year of maturity that do not pay a coupon. Those are bills. The issue with bills, and why bills are so important in this equation, is that bills represent a much more liquid instrument. And if you accept that a generic definition of liquidity is equal to the ratio of an asset divided by its duration or its maturity, you can see by shifting towards lower maturities in asset issuance or debt issuance, you're actually improving the liquidity of the system. More pointedly, who buys these bills? The answer is banks. Banks love bills and short-dated debt because it duration matches their liabilities of short-term bank deposits. And so they buy these with great appetite. That is called monetization of the deficit, and that is something that monetarists like the late Milton Friedman will be turning in his grave about. I mean, these are bad numbers. And as the famous investor Stan Druckerman has said about 12 months ago about some of these numbers coming out of the US Treasury, these are numbers you would normally associate with Argentina, not with the United States. And this is the problem. So what you've got here is this hidden stimulus, $6 trillion at the peak. Current Fed current Treasury Secretary Scott Bessent has accused Powell and Janet Yellen, his predecessor, of secretly stimulating the economy to try and get Biden re-elected last year. Clearly that failed. But that was a secret stimulus. That had a big impact on the US economy. It has come right down from 6 trillion to under 1 trillion. So the second derivative is important. And this is the impact it's had on the US economy. And what I show here is that same stimulus in orange advanced by 12 months against the Philadelphia Fed manufacturing survey to try and show that there was a meaningful impact in some of those in that stimulus. That is now coming off, running off, and that runoff is basically causing the world economy to slow markedly. This is a daily AI-based analysis we do of the world economy, trying to estimate world GDP. And what you can see going on here is that world GDP is starting to slow down dramatically. It's slowed down from the middle of December, and that slowdown predated the current tensions about tariffs. So this is not tariff related, this is something else. The tariff stuff comes on top or alongside. So what you can see here is the world economy is slowing down markedly. Why is this important? It's important because let's get back to the debt markets and credits. What you have seen is, or what you are seeing is a credit market that is increasingly deteriorating. In fact, I should go back one stage to show you this chart. This is the risk cycle worldwide, and this is looking at the deployment of investor portfolios in different asset types. And if you're above the line, the zero line, you are investing above average in risk assets. If you're going below the line, your portfolio allocation is going more and more into safe assets like government bonds or cash. And what I've done is to discriminate between the US in red, US in orange, and the world in red. World risk exposure in red has gone down, but the US has plunged. And that plunge in US risk appetite is all about the slowing domestic economy. And that is clearly something that we've got to be concerned about. The chart that I flashed up previously is looking at US corporate spreads. And the orange line is looking at the single B spread against the AAA corporate bond. And what that is telling us is we're at extremely tight spreads, but they're beginning to blow out. So what we saw as of yesterday was that the CCC bond, the even lower grade bond, a junk bond, hit 13.25% yields, which means its yield is up 200 basis points in the first quarter. So this is quite a big move. I mean, it's got a lot more to go if it deteriorates, but that's what's happening. And going back to my days at Salomon Brothers, one of the things that I was always alert to was that the signaling effect of the treasury market yield structure or the yield curve on as a leading indicator for what happens in the corporate debt markets. Whenever you get a jump in convexity in the curve, which is basically saying how much the 5-year note trades above the 2 and the 10-year notes, you get an idea of how much the curve is bulging. And it's that bulge which gives a very, very good heads up as to whether the credit markets will deteriorate. And what you can see is every time you've seen a jump in convexity, you've seen a jump in credit spread, or credit spreads have widened. And that's what's going on. How rich are the markets? Well, just take a look at this. This is looking at, again, the single B benchmark bond, the Bank of America Merrill Lynch index of what is the generic yield on a single B credit in America. And the black line is a 30-year mortgage. Now, notwithstanding the fact that they have different durations and convexities, the fact is that the mortgage bond is government backed, okay? And what you've got is the single B corporate bond is trading through that 30-year mortgage rate. And that is astonishing. It's never happened before. That's how rich the credit markets are. So what I'm saying here is, as they say, Houston, we've got a problem. There is a potential credit risk coming up. And why is this critical? Is if I just go back to what's happening with the Federal Reserve. This is the Federal Reserve's activities shown in terms of bank reserves. Now, without getting caught in the weeds here, the orange line is US bank reserves. The dotted line is our projections. The dark red line is a one standard deviation displacement to try and estimate the risk in the tail of the distribution of reserves among the smaller regional banks in America, which is where you got the SVB crisis before. And the red dotted line, the bright red dotted line, is our estimates of minimum reserve levels. And basically what you find is September of this year, that red line definitively, the projection rather of bank reserves goes through, falls beneath the minimum reserve threshold. So that should tell you, as you're dancing around this this threshold, repo tensions start to build. And as I said, look, there's the evidence. It's already stark, and this is what the Federal Reserve should be looking at. It claims it is, but no action yet, and that's the danger. So we're running out of money by September. The markets will be, have a bigger problem.
Right. So we're probably looking into something like we're gonna see this pain continue for a little while. We're gonna maybe have a credit event, some panic of sorts, and then we will get the response from the powers that be, and then we'll maybe recover after that. We'll see where we end up in the meanwhile, I suppose.
We will recover, there's no question, because the fact is that liquidity is always cyclical. And this is our global liquidity cycle, which goes right back to the 1970s, which is the heartbeat of what we do. And what you can see is you get regular cycles. The concern we've got, as you can see in the latest data print, and everything has moved on track, by the way, in the last couple of cycles. It's been absolutely exact that global liquidity has shifted along this 65-month or 5 to 6 year cycle. Why is that cycle so important? Because that's the debt refinancing cycle. That reflects the average maturity of global debt. That's why you've got this cycle. And, as I keep saying, we live in a world now which is not the textbook world of capital spending, where capital spending drives economies, where interest rates are important as a cost of capital to attenuate the capital spending cycle. Those years have gone. Those days have gone. We're not in that world anymore. We're in a world of debt refinancing. Markets are all about refinancing debt. Something like 3 out of every 4 transactions in financial markets is a debt refinancing transaction. And in a debt refinancing world, it's not interest rates that matter, it's balance sheet capacity and liquidity. And this is the heartbeat of the system. So if you get liquidity going into the system, liquidity is fungible, and it basically floats all asset prices. And we've seen this bull market, which has unfolded basically since September of 2022, and it's gone on track. What we're seeing now is a flatlining, which is disturbing, and that flatlining may cause the cycle to sort of top out early. There has been precedence of that before. You can see during 2020, 2012, 2014, 2016, you've got basically a very truncated cycle. And that maybe is what's happening right now. But we've got to be alert to these factors. And if you start to look in more detail at what the central banks are doing, these are indexes of all central banks, their activity. And you can see there's a lot of volatility creeping in because of what China's doing. China, by the way, is actually getting its act together right now. And we're actually a lot more upbeat about China and have been since the beginning of this year. But the bigger Western economies, America, Eurozone, plus Japan, are flatlining if you look at those indexes. And that is not good.
Yeah, I was just about to ask you about China here. What is their role? Can you expand on that? And maybe can they prolong the cycle? Are they big enough or strong enough? Or how do you see that?
let me try and say something about China, because China is really very interesting right now.
Yeah, it is.
The first thing to say is that this is looking at the Chinese 10-year bond yield in orange. The bond markets contain huge amounts of information, but the important thing is to interrogate them properly to get the right answers. And what you need to do to understand the bond markets is really to split out something which is a wonkish concept for many investors, which is called the term premium, which is effectively the risk premium that is embedded within the bond. And what I've done here is to extract that from the Chinese market, which is shown here daily in black. And this is the implied term premium on Chinese 10-year government bonds. Now, what you can see is a plunge in the orange line from late 2024. And that plunge in yields is eye-wateringly large. It is something that you do get in bond markets, but it's sort of end of the world stuff. And it basically is telling you that China is falling into a significant debt deflation. So, investors are rushing for the safety of safe government bonds. They don't want to take any risk. And as a result of that, the term premium basically starts to collapse. And that's what you can see evident in the black line. Now, what we've seen since that collapse in yields is a bottoming out and a subsequent rally. And that has been mirrored by the term premium. So the term premium is the risk appetite of Chinese investors. What you've basically got here is a significant collapse in risk appetite and then a rebound, a very, very sharp rebound. And that's going on. That is essentially equivalent to what you've been seeing in the stock markets, where the stock market sold off and has now rebounded strongly. So what is going on? Number one is, why did China tighten so much, which it did do in late 2024? The reason the bond market collapsed was that the People's Bank of China hit the brakes significantly. Reason being is that the dollar was very strong, and the People's Bank, or the Chinese monetary authorities, are targeting the yuan against the US dollar. So if the dollar is seeing a surge after Trump's election victory, the Chinese basically have to tighten to keep the yuan elevated with the US dollar. So strong dollar is squeezing China hard. The since softening of the dollar, and maybe the acceptance by the Chinese authorities that they need to get the economy restarted, led to a huge policy change. And this is the People's Bank's liquidity injections into their markets. Now, this is shown seasonally adjusted and as a rolling 3-month figure to get out some of the distortions in the markets caused by things like the Lunar New Year, which is a floating festival in China. But what this shows is some big numbers that are coming through. So what you've got is, over the last 3 months, you've seen something like 4.5 trillion yuan injected into their money markets. So if you annualize that, you're talking about 18 trillion for a year, which is something like $2.5 trillion, which is equivalent to what America threw into its financial system in the wake of the GFC. So you're seeing an equivalent point and an equivalent inflection in our view. And that is beginning to turn the Chinese economy and system round. Now, if you look behind the Chinese data, this, I think, is a really interesting chart to ponder on, because basically what it's telling us is why the gold market is so strong. Now, in my view, what China has to do is to devalue its currency, its real exchange rate, because that's the only way that you get out of a debt deflation. And China has got too much debt, and prices were clearly deflating. High street prices and asset prices were deflating. So what you've got to do is to offset that with a monetary inflation, and a monetary inflation means that you're devaluing your paper money. Now, if you ask the question of most people and you said, okay, China has to devalue its currency, what is it going to devalue against? And most people would argue, not unreasonably, against the US dollar. But clearly that's not the answer, because the Chinese yuan is not uncompetitive against the US dollar. I mean, look at China's whopping trade surplus and looking at the anger or how much it vexes President Trump. So he's not going to allow the Chinese to devalue against the US dollar at all, right? But actually, it's not the dollar that's the key benchmark. You've got to think that China needs to devalue its paper money against real assets. That's the problem. So a good real asset is the gold price. So if you look at the orange line, this is telling us what China's been doing. And China has been devaluing its currency against gold dramatically. Now, when we first did this analysis, we said, and this is back in 2023, that the Chinese debt to liquidity ratio, if you remember that ratio from earlier in my discussion, The debt liquidity ratio is critical. In China's case, debt to liquidity was 30% above its long-term average. And therefore it needed either to get debt down, which is impossible, or to get liquidity up, which is what they could do. So they need a big monetary stimulus. And if they have a big monetary stimulus, the yuan would devalue. So we said that China would get out of its debt deflation, or begin to, once the yuan or renminbi gold price hits 26,000 per ounce. When that chart was first, or when this was first mooted, gold in yuan or renminbi was 11,000. So it had to more than double. It has already doubled, because as of yesterday, the yuan gold price was 22,500 renminbi per ounce of gold. It's well on its way to 26,000. China is well on its way to getting out of debt deflation. And this is what we've got to acknowledge. Now, the key question here, which is basically causing a lot of head scratching among analysts, is that we don't think about China as setting the world gold price. We think that gold is formed in the London gold market, as it always has been since the 19th century. And because the London gold fix is so important, and we assume that that the US dollar yuan exchange rate is held steady by the monetary authorities in China and the US, that triangulates back to a yuan gold price. But that's not the right way to think about it anymore, because the Shanghai Gold Exchange is probably the dominant driver of the actual gold, the physical gold price. So it's actually the price setter is China here, and China is focusing on, in our view, trying to deliver a 26,000 yuan per ounce gold price. China is the world's biggest producer of gold. It's a huge hoarder of gold. Its people love gold. And this is a wonderful way of actually transferring wealth to the Chinese, back to the Chinese. And so what they're doing is controlling the gold price. Yuan US dollar fixed at, let's say, 7.3, 7.25, whatever number you like. That will triangulate back into a gold price of $3,600 per ounce. So that's the way that we're heading. Gold is going up because there's monetary inflation going on worldwide, but the driver is not the Federal Reserve here, it's the Chinese and the People's Bank of China. And that basically is what's going on. So we think you've got to start acknowledging these monetary inflation events. Central banks are not going to put their hand up and say, look, please investors, see what we're doing here. We're inflating the world. They're not going to fess up to this. It's happening, before our eyes, but this is the way that they get out of debt problems. They're kicking the can down the road all the time.
Do you think that maybe there's a chance that the Chinese equity market takes a little bit of the piece of the pie of gold, let's say, there, that people might diversify?
It is happening already, but this is what's been going on through the last 3 or 4 months. Chinese equities bottomed late last year, and they're rising strongly.
Do you think that'll continue?
Yeah, it would continue as long as the People's Bank can inject liquidity into the system, and that really comes back to what their desire is about the yuan US dollar gold price. And I would venture that what we know is that President Trump wants to do a deal with China. That's the big deal that he will get credit for. America needs the Chinese economy. The Chinese economy needs the US economy. Let's be realistic here. They're closely dovetailed industrially. So there has to be a deal, and a deal could take the shape of allowing the yuan gold price, the yuan dollar cross rate to stay where it is. Okay, so that's accepted. And what happens is that the Chinese are allowed to push up physical gold in yuan, which means that the US dollar gold price goes up more. Now, wouldn't that actually help the US Treasury enormously? Haven't we heard rumors that Scott Bessent wants to revalue the US gold stock, which is carried on the books of the US at $42 an ounce? That would be a wonderful windfall gain for the Treasury. It would basically deliver $1 trillion of free cash for them to basically spend and not tax or not issue coupon debt. And that would square all circles, because it would mean that if you didn't have to issue debt for 2 years or whatever, you would start to see yields drop enormously at the long end of the market, which would ease the funding strains of the US Treasury and, bring a smile to Scott Bessent's face, I'm sure.
Is that how high of a likelihood event do you think that is, and maybe
50-50.
how soon?
I think as high as 50-50.
And this year, next year, or what?
Well, I think that put it this way. I mean, Scott Bessent gave us a hint where he said that the assets on the U.S. balance sheet will be revalued upwards in the favor of the U.S. people, Americans, and he said that will happen within 12 months. Now he was basically obscure about what that meant, and he's since said, "I didn't mean that I was going to revalue gold, but hey, let's see." There's not much else they could revalue. They can't revalue the U.S. Parks Department. They can't do much with the U.S. military establishments. So the only other assets are Fannie Mae and Freddie Mac, which are smaller than this, or the U.S. gold stocks. So it's one of those other two, I would suggest.
You're bullish Bitcoin, you're bullish gold, you're bullish China, the equities. I was wondering, since we've seen that rotation, especially as of late, it's really picked up steam there, going from to other countries as well, or also to Europe. A lot of emerging markets doing well. What are you seeing there? Are there also other countries that you think might profit from this dynamic, or that you're bullish on just for maybe other reasons or so?
Well, I think the thing is you've got to separate. What I'm saying here is that to be clear, there is only one central bank that's clearly easing from what we see, which is the
Yeah.
People's Bank, and that's a big one. The Federal Reserve is sitting on its hands. We don't know what it's going to do. It's basically slowed its QT operations. But if you look at the charts I indicated earlier, we're coming to a fork in the road where they're going to have to make a big decision about whether they stay pat and, if you like, cause or lead to a financial crisis because we need liquidity, or they start to inject more liquidity into the system. And I don't know what the Federal Reserve is going to do. I think it's very strange they haven't acted, or more particularly haven't said anything yet, but they definitely need to. And that is an uncertainty. So I'm not going to chase markets right now. I think it's too dangerous. On a long-term view, there is only one course open to all central banks and monetary authorities worldwide, and that is to print money. That's all they can do. The debt burdens are enormous, and they're only getting worse because we're in aging societies. We've got mandatory commitments to welfare spending. Europe has got to take on a big defense bill. The German debt brake has come off, and we're going to be saddled with more and more debt. And politicians find this easy because they can kick the can down the road. Now, all I've said to you is, or what I've stressed is, that if you look at the long-term picture, whenever you get big increases in debt, the gold price goes up because the mechanic is increases in debt mean increases in liquidity, which you must have for financial stability reasons in the longer term. No policymaker is going to let the financial system collapse. They may not be prescient, but they're going to come in after the event, as they've done in every other financial crisis, and throw liquidity at the system. And that's when you've got to start building up exposure to risk assets again.
I guess maybe it's fair to say that on the country side, you're bullish on China. On the commodity side, you're only bullish on gold, or
Well, not necessarily. I mean, I think that it's well worthwhile, thinking about industrial commodities because China is such a large engine for the world economy. And if the Chinese economy starts to pick up, then commodity markets are going to start to rise. That's for sure. However, we have to acknowledge the fact that what's going on in the US also matters, and the fading of this hidden stimulus that occurred from last year, the sort of pump and dump, if you like, that was occurring from the Treasury and the US Fed, that's fading, and that's a drag on the US economy, throwing some tariff uncertainty, and it's not impossible that the US economy will see a mild recession. Now, if that's the case, you want to be out of credits and you want to be wary about too much exposure to cyclical stocks in the near term. And maybe it makes a lot of sense in that environment to start going for short to mid-duration government bonds because it's very likely that policymakers will, at the first sniff of recession, slash interest rates pretty fast. And on that basis, 2-year, 5-year bonds become great performers. So that's what I will be doing tactically. But equally, I think alongside, I'd be thinking about buying on weakness any industrial commodities or any industrial commodity shares.
Yeah, that makes sense. It seems like there's a little bit of a war between you on one side you have the dollar, on the other side you have the recession prognostications, and a lot of uncertainties in between that maybe people aren't all that keen maybe yet on flooding to commodities here yet, but maybe that's something that we'll see in the next few years. And it's also what I'm betting on now. I think it has a bright future, not only gold, but a lot of other commodities as well. Yeah.
I think that makes sense, yeah, particularly rare earths because China is a major producer of rare earths and is, you know, pulling up the drawbridge, saying that they're not going to export to the West or competitors. So I think that's clearly something we need to address.
Yeah, agreed. Do you have any final thoughts here before we let you go? Of course, I gotta put this up here. This is your book.
Oh, Capital Wars, the
Yeah.
book. Yeah, okay, well, that's very kind. I think that's. I mean, look, broadly speaking, the main point is that what you've got is we're in a world dominated by debts. In a world dominated by debts, liquidity is all important, not interest rates. You've got to understand the liquidity framework, which means looking at the repo markets and the collateral markets, and that really matters a huge amount. And if you want a heads up as to a warning of maybe how tensions are building, start to look at the repo spreads, such as SOFR rates less Fed funds, and that will give a lot of insight. But where I'm positioned at the moment is nervously. I've been big in gold. I've liked Bitcoin. The trouble is that Bitcoin is a very cyclical instrument. If the economy goes into recession, Bitcoin will come off in price. But from a long-term standpoint, this is a great buying opportunity because Bitcoin is going to outperform in the long term because it's a brilliant monetary inflation hedge. There's only 21 million coins ever going to be made, and that has to be good when debt is being printed all the time by governments. So I think these are the things to understand, and it's all about global liquidity, in my view.
Yeah, sounds good. Very insightful. Thank you very much for coming on. I'm gonna have to rewind this a couple of times, I think, to get all the information here. Very nice. Sorry.
We write a blog on Substack which is called Capital Wars, which is the same name as the book I wrote, and that goes into all these different arguments and provides data for particularly for high net worth and family office businesses.
Yeah, I highly recommend it. It's very valuable. You're one of my favorite accounts on Twitter also to follow. And again, I want to thank you for coming on. I really appreciate it.
Great pleasure, Bart. Thank you.
Thank you very much.